Tomorrow, a committee of 12 men and women who have never met you, never seen your bank statement, and never once considered your retirement date will publish a document that could move the price of gold by $100 before your coffee gets cold. Most people watching gold and silver right now have no idea it's coming. Fewer still know what to look for inside it. By the time you finish this, you will know both, and you'll know it before the market does. A brief and honest word before we begin. What follows is research, carefully assembled, but markets move faster than any script can be written, and numbers you're about to hear may already have shifted by the time you're watching. Nothing here is financial advice, nor even a gentle suggestion of it. This is education, a way of understanding the machinery a little better than you did 5 minutes ago. What you do with your own money remains, as it should, a conversation with someone who actually knows your circumstances. There's an old and useful discipline, largely abandoned in an age that prefers headlines to history, of reading institutions the way one reads people, by what they choose not to say as much as by what they announce. Master the metals market with the ultimate silver trading manual. Launched just last week, over 1,000 traders have already grabbed their copy and are leveraging these proven strategies, with many buyers reporting thousands of dollars in profits. This is your one-time investment to unlock not only an action-packed trading guide, but also exclusive free access to our private Telegram and WhatsApp community. Inside, you'll get ongoing real-time support, market updates, and direct guidance to help you execute confident, profitable trades. Don't sit on the sidelines while others capitalize on the market. Grab your copy now and transform your trading today. The Federal Reserve is such an institution, and this week it is about to reveal, in the fine print of its own internal record, precisely the kind of quiet disagreement that headlines never capture, but markets always eventually price in. Consider first what the Federal Reserve actually is, since familiarity has a way of curdling into misunderstanding. It is the central bank of the United States, the institution entrusted with the peculiar and enormous power of setting the price of money itself. The federal funds rate, a single number that ripples outward through every mortgage, every auto loan, every corporate bond, and eventually into the value of a metal that has outlasted every currency ever printed. Raise that rate, and borrowing grows expensive. The economy exhales. Lower it, and credit loosens. The economy inhales. It is, in its way, the closest thing the modern economy has to a heartbeat. And like any heartbeat, its irregularities are watched far more closely than its steady rhythm. Inside the Fed sits a smaller body, the Federal Open Market Committee, 12 voting members, the 7 Washington governors joined by a rotating cast of regional bank presidents who convene roughly every 6 weeks to argue in closed session over where that heartbeat should go next. What the public receives afterward is a statement, brief, polished, diplomatically vague, the verbal equivalent of a judge's verdict read aloud without the deliberation behind it. 3 weeks later comes something far more revealing. The minutes, the actual transcript of the argument itself. If the statement is the verdict, the minutes are the jury room. And it is in the jury room, not the verdict, that you learn how close the vote really was and what might change it next time. Here is the connective tissue between that room and the price of gold. And it is worth understanding once properly rather than half remembering forever. Gold pays no dividend. It offers no interest. Its worth is not what it produces, but what it is, a physical claim on value that has outlived every empire that ever tried to debase it. When interest rates rise, or are merely expected to rise, a treasury bond paying a handsome yield begins to look like the more sensible companion for one's money, and gold, offering nothing but itself, loses ground. When rates are expected to fall, that calculus reverses, and gold's ancient appeal, the fact that it answers to no chairman, no legislature, no printing press, reasserts itself. Economists call this the opportunity cost of holding gold. It is, at bottom, simply the eternal argument between the comfort of yield and the certainty of substance, replayed in every trading session since Bretton Woods collapsed. Now to the meeting itself, the one whose minutes arrived Tuesday, drawn from 2 days of deliberation on July 28th and 29th. The headline decision was almost tediously predictable. Rates held steady at 3.12 to 3.34% for a 5th consecutive meeting, and outcome futures markets had priced at 97% before the gavel even fell. But beneath that placid surface, 3 regional Fed presidents did something markets do not see often. They dissented, and not gently. They wanted an immediate quarter-point hike, right then, no waiting. It was the sharpest hawkish revolt inside the Fed since 2016, a full decade of institutional memory since that many voices broke from the chair in open disagreement. Markets sensibly took notice. The odds of a September hike leapt from roughly 1 in 6 to nearly a coin flip within weeks. And Fed Chair Kevin Warsh, in his remarks afterward, made his priorities plain. Price stability first, employment concerns a distant second. In language central bankers use precisely because it sounds, on its surface, so unremarkable. And then, in the space of 10 days, the ground shifted beneath that hawkish mood entirely. July's consumer price index came in softer than forecast. The producer price index, which tends to foreshadow retail inflation by several months, softened as well. Non-farm payrolls disappointed. Retail sales, which had climbed for 9 consecutive months, fell 0.6% in July, the first meaningful pullback in nearly a year. And the University of Michigan's Consumer Sentiment Survey collapsed to 51, a full 8% monthly decline, even as the same survey showed inflation expectations climbing to 4.3%. Weak growth and rising inflation fears arriving in the same breath. Economists have a word for that particular discomfort, and it is not a word central bankers enjoy hearing: stagflation. It is the condition in which a central bank finds itself with no clean answer, only a choice between two different kinds of damage. And when institutions run out of clean answers, gold has, across recorded history, tended to do rather well. Not because anything is thriving, but because the alternative looks less certain than it did a month before. By last week, that combination of data had pushed September's hike odds from a coin flip down toward roughly 1 in 3. Gold, which had drifted as low as the $4,000 range earlier this year, rallied on the shift, trading near $429 an ounce as of Tuesday, its best monthly run since January. Silver climbed alongside it, changing hands around $65 to $66 an ounce, with the gold to silver ratio sitting near 67 to 1 against a 50-year historical average closer to 65 to 1. A gap that, history suggests, tends to close quickly once sentiment turns. Which brings us, at last, to Tuesday, and to a chairman who has made a habit since taking his seat of telling markets rather less than his predecessors did, and why that habit alone may be worth more to the price of gold than anything written in the minutes themselves. That is where we turn next, and it changes how you should read every word the Fed publishes from here forward. There is a particular kind of power that comes not from what a man says, but from what he declines to say. And in June of this year, Kevin Warsh exercised it in a way no Fed chairman had exercised it in 14 years. He withheld his own interest rate projection from the Fed's quarterly summary of economic projections, the document markets know with a certain affection as the dot plot. It is worth pausing on what that document has meant since Ben Bernanke introduced it in 2012. Every voting member of the FOMC, chairman included, submits an anonymous forecast of where the federal funds rate ought to sit over the coming years. Plotted together, those forecasts form a kind of collective roadmap, and markets, which despise nothing more than genuine uncertainty, have spent a decade organizing their expectations around it. A visible map compresses fear. It tells investors roughly where the ground will be 6 months from now. And when you know roughly where the ground will be, you need not hold quite so much of the one asset designed for the possibility that the ground moves without warning. Warsh opted out of the map. He offered no dot, no forecast, and only the thinnest explanation for the omission. Market participants who follow his public remarks have settled, with some consistency, on the same handful of adjectives to describe his communication since cautious, ambiguous, difficult to read. No forward guidance in the traditional sense. No here is the path, and here is what would change it. Just silence, dressed in the studied plainness of central bank English. Consider what that silence does to money. When the single most consequential monetary official on earth becomes genuinely unpredictable, capital does not simply sit still and wait to be surprised. It drifts quietly and rationally toward assets that do not require any chairman to make the right call at all. Gold has performed that particular function for roughly 5,000 years for the simple reason that it answers to no one's discretion. It cannot be devalued by a policy pivot, frozen by decree, or talked down at a podium. The uncertainty Warsh has introduced by his silence is not the dominant force behind gold's rally this year. That distinction still belongs to the real yield mechanism we've already walked through, but it is real, it is measurable in the tape, and it will remain a quiet tailwind for as long as his public style stays this opaque. Tuesday's minutes will be the first genuinely detailed window markets get into how this chairman actually operates inside that room, whether he is drifting toward the 3 dissenters who wanted to hike immediately or anchoring firmly to patience while simply saying less about it than the men who held the job before him. Now, before we go further, and I promise you this part matters more than it sounds like it should, if you've made it this far, you already care more about getting this right than the average person scrolling past a headline. That's exactly the kind of viewer this channel is built for. And it's exactly why I'd ask you, genuinely, to subscribe before you keep watching. Not because the algorithm needs it, though it does, but because Wednesday morning, when this document actually lands and gold either breaks higher or gets turned away, most people are going to be reading hot takes with no context behind them. You won't be one of them if you're subscribed, because the follow-up breaking down exactly what happened will already be waiting in your feed instead of buried under everything else. It takes 4 seconds. Do it now, and let's finish this properly. So, what should you actually be looking for when the minutes are published? Not a checklist to skim, but a way of reading the language underneath the language, the way a good editor reads a politician's speech for the sentence he chose not to include. Begin with how the committee characterizes inflation itself. Every set of minutes discusses inflation. That much is guaranteed. What matters is the specific framing chosen. If the language describes inflation as elevated, persistent, or not yet on a convincing downward path, the committee is telling you, in the careful vocabulary of central banking, that it is not ready to stand down, and September remains genuinely live. Compare that against language suggesting inflation is moderating, or that recent data has been encouraging. The distance between those two phrasings is not subtle. It is roughly the difference between 20 percentage points of hike probability, and 20 points of probability translates, historically, into something close to $100 on the price of gold. Read next how the minutes treat the labor market, because the Fed operates under a legal mandate to pursue both price stability and maximum employment simultaneously, two goals that, inconveniently, do not always point the same direction. If the minutes acknowledge real softening in employment, slower hiring, rising claims, cooling wage growth, the committee is effectively conceding that its own policy is beginning to do damage, which limits how aggressively it can act without making that damage worse. That is a dovish signal. Downplaying labor market weakness, by contrast, tells you the committee still believes it has room to move. The signal most casual readers will miss entirely is buried in how the three dissenting votes are actually described. The count, 9 in favor of holding, 3 against, is already public. What the minutes add is texture. Were those 3 dissenters treated in the discussion as an isolated fringe, or did their reasoning occupy real space in the conversation, with other members expressing sympathy even while declining to act on it yet? That second scenario tells you something the raw vote count cannot, that the real gap inside that room may be smaller than 9-3 suggests, that there may be 4 or 5 members leaning hawkish who simply held their vote. That is a materially more threatening read for September than a clean split ever could be. Watch, too, for how the phrase data-dependent is used, because in most environments that phrase is nearly meaningless filler. Not this time. With 3 members having just voted for an immediate hike and September odds having flirted with 50% only weeks ago, data-dependent carries real freight. It means, in plain terms, we agreed not to move today, but we have not agreed to hold in September either. Whether that door reads as closed or merely ajar is worth more than almost anything else in the document. And finally, watch whether the minutes give explicit weight to geopolitical risk, specifically the standoff between the United States and Iran over the Strait of Hormuz, the narrow channel through which roughly a fifth of the world's traded oil still passes, and which has kept Brent crude hovering near $90 a barrel through the summer, even as tensions in the wider region, from Lebanon to the Gulf, remain unresolved. If the committee treats that pressure as structural rather than temporary, it is telling you that inflation has a floor beneath it that no amount of cooling domestic data can fully erase, and that is the environment in which gold carries a geopolitical premium and a rate premium at the very same time. 2 roads lead out of Tuesday, and it's worth walking down both before the market chooses one for you. There is a temptation, in moments like this, to want a single confident answer, up or down, buy or wait. And financial media is only too happy to supply that confidence, usually at the exact moment it is least warranted. The honest posture is a different one. Understand both paths clearly enough that whichever one the market takes, you are not surprised by it, only informed by it. The more probable path, given the run of data since that July meeting, is the dovish one. In this version, the minutes confirm what the price action has already begun to suggest, that the majority of the committee was genuinely comfortable holding, that the 3 dissenters are framed in the text as an outlying minority rather than the leading edge of something larger, and that the language around inflation has shifted noticeably toward words like moderating rather than persistent. In that environment, September's hike odds, sitting near 1 in 3 as of this week, could drift down toward 15 or 20%, and the real yield relief that follows would likely carry gold, already trading in the 4,400s and testing resistance it has probed all week, toward fresh highs in the neighborhood of the $4,500 to $4,550 range. Silver, in that same scenario, tends to outperform gold on the day itself. When the monetary headwind lifts, silver's other story, the industrial one, gets to speak again without being shouted over. The gold to silver ratio, sitting near 67 to 1 against a 50-year historical average closer to 65 to 1, has room to compress, and it has a habit of compressing quickly once sentiment turns. The less probable path, the tail risk, not dismissible simply because it's less likely, is the hawkish one. Here, the minutes reveal that the dissent inside that room ran deeper than 3 official votes suggest, or the inflation language stays tight, or September is framed less as a settled matter and more as a live and open question. In that scenario, hike odds could climb back toward 40 or 50%, and gold would likely retreat toward support in the low $40,300s, with a test of the month's earlier lows near $4,300 not out of the question. Silver would feel that pressure more sharply than gold does, because silver carries a burden gold never has to. It answers not only to interest rate expectations, but to industrial demand sentiment as well. And when rate fears intensify, both forces compress it at once. But here is the sentence worth carrying out of this video longer than any single price target, because price targets expire and this does not. A hawkish set of minutes is a headwind against the precious metal story, not a reversal of it. The real yield mechanism can toss gold's price around violently in the space of a single week. What it cannot do is buy central bank reserves, and those reserves have been buying regardless of what any committee has said. China's central bank has now added to its gold holdings for more than 20 consecutive months without interruption. Central banks worldwide purchased close to 289 tons of gold in the second quarter of this year alone, a near record, even as prices wobbled. The Silver Institute has now confirmed a sixth consecutive annual global supply deficit, and gold itself has quietly overtaken U.S. Treasuries as the world's second largest official reserve asset. None of that architecture reverses on a Tuesday afternoon because 3 regional bank presidents disagreed with 9 of their colleagues about the timing of a quarter-point move. The mechanism creates the weather. The architecture is the climate, and it is worth knowing always which one you are actually looking at. There's a kind of humility unfashionable in an age that prefers certainty to accuracy, in simply admitting how quickly the weather can change without the climate beneath it changing at all. In January of this year, gold traded above $5,600 an ounce. By mid-year, it had fallen back toward the $4,000 mark, driven down by the same real yield mechanism that has since, in the span of about 10 days of softer data, pushed it back up toward $4,400 and beyond. The mechanism worked exactly as it always works, and the entire time, through the fall, through the recovery, through every headline in between, the central bank buying never stopped, the reserve diversification never paused, and the silver deficit never closed. That is the distinction worth holding on to, longer than any single Wednesday. Ask not merely what just happened, but whether anything structural actually changed. Most of the time, if you're honest with the data, the answer is no. Tuesday is nearly here. You now know what those minutes are actually measuring, what the specific language means when you see it, and what both roads out of that document look like before either one is chosen for you. If this changed how clearly you can see Wednesday morning coming, do one more thing before you go. Leave a comment telling me which scenario you think is more likely, dovish or hawkish, and why. I read everyone, and the best comments genuinely shape what I dig into for the next video. After the minutes actually publish and the market has had its say, I'll be back with the follow-up. Exactly what the document said, how gold and silver actually responded in the hours after release, and what it means heading into the September 15th and 16th meeting. Say your prediction below, let's see who was right. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in.